Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look at a number of different things outside of the S&P 500. We do look inside of the S&P 500 to look at past earnings and where they are in relation to current price. And we look at forward projections for earnings and where they are in relation to current price. Then we do a pretty good breakdown between growth and value. Typically, when the market's really going up, growth will outperform value. When the market is getting more defensive or declining, value will tend to outperform growth. So we keep a close eye on that. And then we look at other markets like commodities markets, currency markets, other indexes, other sectors, and relate them all to the S&P 500 to get some insight as to what's actually going on in the market. This is being prepared from Monday, October 14th. I do have a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. Feel free to check that out. There are additional videos that I post there. There are courses that I'll be doing either live or pre-recorded. If you want to learn more about that, there's a link that will take you to the website. There's also a link that will talk about the program more in depth. If you have any questions, you are more than welcome to send me an email. And this video here, the InterMarket Analysis video, is just one of the weekly videos that I do. All of the videos that I do over the weekend are meant to tie into the daily video. And sometimes things don't change all that quickly, but we can see things change bit by bit and often see things before they happen in the market. Now, sometimes, like in the past week, we've been watching some things that looked rather negative and were giving us some warning signs. But to this point, they're still there. They really haven't led to anything negative. But we just want to be aware of those things anyway. Okay, let's go and look at S&P 500 valuation. This looks backward at the trailing 12 months and compares what earnings were back going back to 1980 compared with the price of the S&P. And what they do is they come up with a thing called the PE ratio, the price to earnings ratio, and they have static numbers to measure whether the market is considered to be expensive, fairly priced, or cheap. And we plot the current value of the S&P here, which just set an all-time high on Friday, and compare it to the PE ratio of 20 looking backwards. And this can show you that, yes, we are in fact overvalued, but we've been overvalued for years, and the market can stay overvalued for a very long period of time. To break that out a little bit more, this red line down here just shows the current price versus the red dashed line here to also suggest that we are overvalued. We don't use this as a timing mechanism. We just use this to understand, okay, the market's overvalued, but it can stay that way for a long period of time. Then, to give some more context, going back to 1980, here are different events that have happened and then what the valuations were at that time. Robert Shiller developed a different way of looking at the PE ratio to smooth things out over a 10-year period of time with the Shiller PE ratio. So instead of just taking earnings by earnings, he uses a more smooth approach with earnings and has come up with his own PE ratio. Right now it's coming in at 37.38, which is considered to be expensive when you compare it to the median and the mean here. I have the box a little out of line. And you can also see what the valuations were at that time. So even on a historical basis, using this more smooth approach, stocks are still considered to be expensive when you just look at it based on the chart. But the market doesn't do that. They look forward and they look at analyst projections and what they think earnings are going to be into the future. And we have a number of different things plotted on this chart put out by Edward Yardeni. The purple area, this is the mega cap 8, and this is a forward-looking PE ratio. And as of October 11th, it's coming in at 28.7. So yeah, it's expensive even looking forward. We're above that 20 level. But these are the big flying stocks, the Nvidias, the Googles, the Apples, Tesla, and so forth. And people want to own those stocks, even if they are considered to be expensive now. They want them to still go up in value because they're having really strong earnings growth in those areas. The one that we focus on is the red line, which is the S&P 500, which, as I said, set a new all-time high on Friday. It's coming in at 21.6, even looking forward. So even when we look out into the future, we're looking expensive. And when we look at the history going back, we're also looking expensive. Now, mid caps and small caps, they showed a little bit of strength this past week. The mid caps are coming in at 16.1, and the small caps are at 15.5, and they're right around that 15 area. So they're considered to be fairly priced at this time. But you have to look at the earnings behind the companies. A small cap company or even a mid cap company, you're like, wait a minute, this is pretty inexpensive. I like this stock price. Well, what are the earnings behind that? What is the PE ratio behind that? Are the earnings growing over a period of time? That's how we look at evaluating different areas. Now, I look at it on the index level to see what are the indexes looking like. And just based on the surface, the small and mid caps are more fairly priced, or the S&P is considered to be expensive. Then we look at growth versus value. I start off by looking at just a growth index itself, which is not setting an all-time high, but is in an overall uptrend. And we look at value, which is doing well. It's also in an uptrend itself, but doesn't really show the big upward movement like we've been seeing with the growth index. But where we get some insight is when we do ratios between the two. And even though it's performed better in the past, growth is still outperforming value. And then I have an inverse of that same chart showing how value is underperforming growth. Then we look at some indexes longer term here, showing how growth is outperforming value and how value is underperforming growth. So we're seeing the same thing so far. And then we look at some ETFs, also showing how growth is outperforming value. And this is a little shorter term, showing how value is underperforming growth. Still seeing the same basic story here. Then we look at another growth index, shorter term, showing how growth has been outperforming, even though it's not doing as well as it was earlier when we set the all-time high in July. Then we look at a couple of ETFs, a growth ETF and do a ratio with a value ETF. This one's not doing as great. It's not doing terrible, but it's inside of the rainbow. When we were really moving up in May, June, and July, growth was really outperforming value. We're not seeing that right now, but we are seeing more participation across the entire market. When you look at the S&P 500 and all the stocks that make that up, they're doing better. And the NYSE is also doing better. And we have some broad market measures that I'll show you later that are also doing quite well right now. So growth doesn't always have to massively outperform, but we spent the last week or two mainly chopping sideways with the S&P 500. We did break out on Thursday and then again on Friday, but we were just chopping in a range for a while. And a lot of that had to do with growth. One day it would do well, then the next day it would not. And we just ended up going sideways. We watch these because if we see a real breakdown in these growth to value ratios, that can give us an early warning sign that the market is getting more defensive. If the growth to value ratios hold up, and they're not looking as good as they were before, but they're still holding up for right now, we can still maintain more of a positive stance on the S&P 500. Then we look at an inverse here showing how value is overall underperforming growth. Then we break it out. We look at the mid caps here, which are in a downtrend, even though they have been showing a little bit of an improvement here. And the small caps also in a downtrend, but improving. They had a pretty good day on Friday. But you can see here's the small cap index. We've just been range bound. Now, we go up a little bit and then drop back, go up and then drop back, go up and then drop back. So that's been a real frustrating aspect to deal with in 2024. This is the one that's a little more encouraging and the one that I focus on the most. This is S&P growth of value inside of the S&P 500. It came down a little bit on Friday, but it's been showing some improvement overall and actually went above the high that was set back in July. We keep an eye on inflation. What you see on top is the CRB index or commodities on a monthly chart. And that's picking up a little bit, but the moving average is still going sideways. And then we do a ratio between inflationary parts of the CRB index and deflationary parts of the CRB index. And for the most part, this is continuing to decline, meaning that inflation on a monthly basis is not really a problem currently. And we look at a daily chart of the CRB index, which is in a downtrend, but it's been bouncing back up. And a lot of this has to do with oil, and oil is really getting kicked around these days by what's going on in the Middle East. So we're keeping an eye on the geopolitical things, specifically in Israel, and seeing if things escalate even more than they already have between Iran and Israel. We look at the Baltic Dry Index, which is really just chopping sideways here. As a general rule, when this is going up, it costs more to ship products. This is going down, it is less to ship products. Now, we are seeing some things going on where, like oil and things in the Middle East, are having to go all the way around Africa. But this is in the Baltic, so we're not really, it's more north. So we're not really seeing a big impact here. But we want to keep an eye on what's happening there. And the price of oil will really reflect that. That's why I look at it every day. Some other markets, aluminum here, which is starting to go back into an uptrend after being in a decline. Corn has been in an overall downtrend, and wheat chopping around, but still in a downtrend. We want to keep an eye on fertilizer because it's needed for all these agricultural products that need to be grown. And it's been going up, but not really moving up drastically lately. Here's oil, and this is mainly what we watch for right now anyway, for geopolitical reasons. We came all the way down into about the 65 range, then we got up to 77. Right now we're about at 75. So if this really starts to go up because things are escalating in the Middle East, that could be negative for the market. We look at a gold to oil ratio where gold has been really doing well, but pulling back lately as oil has been really jumping lately as well. And then we look at another correlation between the 10-year yield and oil, and we see that there's a pretty solid relationship between the two. And we measure that down below. When we get a high reading like this, that means that oil and the 10-year yield are tending to go in the same direction at the same time. Keep an eye on gas, which is still in a downtrend, even though it's been bouncing back up. Some of this could be because of the two hurricanes that have just come through the U.S. recently. And heating oil also in a downtrend right now, but things are starting to turn a little colder right now. Natural gas also still in an overall downtrend. Diesel, we watched that even though it did spike up. This could also be impacted by the hurricanes that have hit the US, but overall it is still in a downtrend. But we want to keep an eye on this. Copper, which is generally considered to be a barometer of the economy, when copper is going up, which is what it's doing now, the economy, at least according to the copper market, is looking better. It was really going up solid. It has pulled back, but it's still in an uptrend. Now we look at a ratio between copper and gold, where copper was really underperforming gold, and then gold was kind of going sideways as copper was coming back up. But when you look at this ratio, we're still in a downtrend overall as copper continues to underperform gold. This is longer term, and I also put the 10-year and 2-year yields on here just to give it a little bit more perspective. You can see how the ratio typically has been going down. Interest rates were going up, and now we're starting to go back up with interest rates, but more or less had been declining. That was giving a little bit of help here to this ratio. We look at gold, and this is just the ETF, not the futures contract, coming off of setting a recent all-time high, but under a little bit of pressure this past week. Silver also not at an all-time high, but still in an uptrend. And we look at the closing value for gold on top and the closing value for silver on the bottom, and we see, which only is logical, that there's a pretty strong correlation between the price of gold and the price of silver. And we do a gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, that means silver's outperforming. And then we plot the US dollar index to see the interplay between precious metals and currencies. And not a real strong relationship right now. It's pretty much neutral at this point where it had been stronger. So we're not really getting a lot of insight from this chart. We look at the dollar, which really bounced up after getting almost down to 100, even though it's still in a downtrend here on the daily chart. And we were bounced up enough to break above this downward sloping trend line as the dollar's been bouncing up lately. And we look at the euro, which is in an uptrend compared to the dollar, but recently pulling back. And the dollar's in a downtrend, but recently bouncing up here. And we also put the Japanese yen here, which the Japanese yen is now in an uptrend compared to the dollar. So I break those out. Here's the euro to the dollar where it was looking a lot stronger, pulling back, but still in an uptrend. And the Japanese yen, which had been in a downtrend for quite a while, now is in an uptrend, even though it's been pulling back lately. And the British pound is also in an uptrend to the dollar, and it came back down to the 50-day moving average here with this ratio. And then we look at the weighted version of the S&P 500, and that's what's quoted. That's what everybody talks about. That's the bar chart right here. But it is a weighted index. So the really big companies, the bigger they are, the more impact they have on the value of the S&P 500. To make it a little more fair, there's an equal weight version where all stocks are treated the same. We're not really seeing much of a disconnect between the two. And this just suggests that even though the big stocks have been lagging since we hit that high in July, the rest of the S&P 500 has been performing quite well. And we look at our ratio. When this is going down, that means the equal weight is underperforming. Well, over the last number of months, we've just been chopping around with this ratio as the equal weight's been doing better when compared to the S&P 500 weighted index. We look at a ratio between stocks and commodities, showing how stocks are outperforming. Here's an inverse showing how commodities are underperforming. The NASDAQ 100, which is now underperforming the S&P 500, enough to generate a death cross here with this ratio. Back in June and July, this is when the NASDAQ 100 was really, really outperforming. And it was just a small group of stocks that were really driving the market higher. The stocks that are in the S&P 500, they're also in the NASDAQ 100. And so there's some carryover. They're in both indexes. And so when the big NASDAQ 100 stocks are doing well, that also drives the S&P up. But typically at that time, that's when you see the NASDAQ 100 outperform. But lately, we've been seeing the opposite of that. The S&P 100 still having a slight tendency to outperform the rest of the S&P 500, and these are the 100 biggest stocks in the S&P 500 on a ratio basis. We look at the NASDAQ, which compared to the S&P 500 on a ratio was starting to underperform, bouncing back, but still in a downtrend with this ratio. And the NASDAQ 100 is underperforming the NASDAQ itself, where back in late spring, we saw an actual death cross with this ratio. They're still doing well, but where the NASDAQ 100 have been really outperforming and really leading things higher, that's not what's happening now. And we look at the mega caps, the really big companies, and compare them with the equal weight ratio. Pretty much chopping sideways now, even though the mega caps are still in an uptrend compared to the equal weight S&P. We want to keep an eye on small caps, and they've really been kind of disappointing in 2024 because they break out and then just come right back. The red line here is the ratio between small caps and the S&P, and overall, it's still showing how it's underperforming. The blue line here is the S&P itself, and you can see there's quite a disconnect between the ratio and the S&P 500 index. Here's another ratio showing how small caps continue to underperform. Even though they were up on Friday and had a good day, longer term, going back to early 2023, they have been really underperforming. When we look at small caps, the tech, when this is going down, that means the tech sector is outperforming. We've been jumping around a little bit here as the tech sector has slowed down recently, but small caps have kind of chopped around as well. And that's why we're getting a real jumble here with this particular ratio. We look at the big software companies, which are showing some improvement and are in an uptrend. The robotics and AI ETF above its rainbow, looking pretty solid when you look at it by itself. But when you do a ratio with the tech sector, it's actually down at the bottom end of the rainbow and has really been underperforming. Mega cap growth, looking really solid here above both the blue line and the red line, showing a pretty solid uptrend, but not back to an all-time high, at least yet. Dow Jones Composite Average, which takes the Dow, the transports, and the utilities together. The Dow just set an all-time high on Friday. The transports were up pretty good. Utilities have been strong lately, but they've been pulling back recently. But overall, this average, when you put all three together, is looking pretty solid. The total U.S. stock ETF set an all-time high on Friday, and this is 2,651 stocks. Very, very broad market measure, showing that things are looking pretty solid. Low volatility stocks, which when you take them by themselves, they are doing well and in an uptrend. But when you do a ratio between the low volatility ETF and the S&P, really underperforming. It had been bouncing back up as they were worried about maybe the economy's falling apart. It was enough of a bounce to at least generate a golden cross here. But since that cross was generated, we've been pulling back with this ratio. Then we look at the advanced decline line, and I do show this in the daily videos. We're above all the moving averages here, and that's the real takeaway with the NYSE common stock, the S&P, the mid caps, and the small caps. We look at traditional Dow theory with the Dow setting an all-time high, the transports just chopping more or less sideways, but now near the higher end of their recent range. Utilities, as I said earlier, were really strong, but lately have been pulling back. And we look at a ratio between the transports and the S&P. When this is going down, that shows how the transports are underperforming. Then we look at the transports all by themselves, just pretty much range bound. Now they're at the higher end of the range that they've been in since the beginning of the year. And we do a ratio between the Dow and the transports. When this is going up, that just means the Dow is outperforming. We look at the relationship or correlation between the S&P and transports. Not really strong, but getting a little bit stronger here. There are times when they have a tendency to go in the same direction. Right now, it's not as strong of a relationship. Then here's a new idea behind Dow theory, where instead of using the Dow, we use the S&P. Instead of using the transports, we use the NASDAQ, where we're setting an all-time high with the S&P, where that's not being confirmed here when we look at the NASDAQ itself. It's doing well, but it still has not come back to the high that was set back in July. Then we look at another kind of derivative of that with the S&P equal weight, which is setting an all-time high. So that shows the S&P is looking pretty solid. We're getting a little closer here to this previous high when we look at the equal weight QQQs, which is the NASDAQ 100. So not confirmed yet, but showing some improvement here. The FANG index still in an uptrend, but still has a ways to go to get back to its all-time high. And I've been pointing this out periodically in the daily videos where we're still below this shorter term trend line. We've not been able to break above that, but we've been able to stay above this longer term trend line with the FANG index. The Wilshire setting a new all-time high here. That's another broad market measure. ARC just continues to chop sideways, even though it's still in a downtrend. And all world stocks, this takes US stocks and leaves them out. When you look at them all by themselves, doing quite well. And when you compare it to the S&P, though, the S&P is still performing better. So even individually, world stocks are doing okay, but US stocks are doing even better now. And then here's a monthly chart of a ratio between the S&P 500 and stocks in Europe, Australia, Asia, and the Far East. When this is going up, that means the S&P is outperforming and we're above an upward sloping trend line. We also plot an oscillator here, which had been kind of flat to even going down. Now it's starting to turn back up. Then we look at bonds. This is a daily chart of the 7 to 10 year ETF just based on price, where it's been going down lately here. And here's the total bond ETF. We're still in an uptrend when we look at the price of bonds, but pulling back as interest rates have been going back up. Same thing here. We're in an uptrend with the world bond index, but pulling back as we have seen interest rates going back higher again. On a monthly basis, stocks still continue to outperform bonds. And this is a daily chart showing how bonds are underperforming stocks. And we look at high yield bonds, known as junk bonds, just coming off of recent all-time highs. Corporate bonds, a little more conservative, really doing well, but pulling back to their 50-day moving average recently. And we look at a ratio between riskier bonds or junk bonds. They're starting to really improve when you compare them to more conservative bonds here. We had actually dropped down with this ratio. Now it's starting to go back up slightly as folks are favoring they're willing to take more risk to get a better yield on things. We look at a stock to bond correlation. They're actually having a slight tendency to go in opposite directions, or quite often they tend to move in the same direction. The Dow Jones Corporate Bond Index pulling back, but still in an uptrend. And we have some fib charts or fib lines on here. We're not really getting all that close to any of these fib retracements. Here's a long-term look going back to 1980 of the 10-year yield where it was starting to go back up, then coming down. Now it's starting to go back up. We did get back up over 4% with the 10-year yield this past week. And here's a 30-year yield chart with the fib retracements here, not really showing anything all that insightful. And we look at the MOVE index, which measures the volatility of bonds, the VIX, which measures the volatility of stocks, not direction, just the volatility of the two. And we see that there's a pretty strong correlation right now between volatility between stocks and bonds. And this is a daily chart of the different yields and the different maturities where we had been really declining. And you see how we're going back up lately. Now, it hasn't had much of an impact yet on stocks, but at some point, you would think interest rates going back up is going to have a negative effect on stocks. But as of the close on Friday, October 11th, it really doesn't seem to matter that much to the stock market right now. Here's a weekly chart looking at international yields here with the US, UK rates going back up, German rates going back up, and even Japanese rates going up as well. And then we look at a ratio between stocks and the 10-year yield, showing how stocks are outperforming even though they have pulled back recently. And this is another ratio. When this is going down the way it is now, that means bonds are underperforming stocks. Junk bonds coming off of recent all-time highs. And we look at a ratio between junk bonds and more conservative bonds. And we're seeing a real renewed interest in junk bonds. Now, we just saw a death cross with this ratio, but this is really starting to go back up now. So we're going to be keeping an eye on this to see, is there some kind of warning signs that we're seeing in the bond market right now that the stock market really hasn't taken hold of yet? Or is the overall economy changing its characteristics to the point where it's okay if interest rates go up and stocks can go up at the same time? We look at the S&P 500 and then compare it with short-term bonds based on price, showing how stocks are outperforming short-term bonds. They're well above the rainbow. The S&P 1500, a broad market measure, also performing short-term bonds. Here's another broad market measure looking at 3 to 7 year bonds. Stocks are still outperforming even on a broad-based basis. And the tech sector improving when compared to 3 to 7 year bonds, but not back to the all-time high yet. Then we look at a monthly chart here of the price of the 30-year, where it had been showing a lot of improvement, enough to turn the moving average back up, but it's really been falling lately as interest rates have been going back up. And then we look at a ratio between the long-term bond and commodities here, where long-term bonds continue to outperform. Then we look at different sectors. And what I do here is first we look at an individual chart of just the sector itself, and then we do a ratio of that sector to the S&P 500. Materials, when you look at it all alone, pretty solid uptrend. But when you do a ratio, it's underperforming the S&P. Communication, looking pretty solid, even though it's been going sideways a lot lately, all by itself. And it's pretty much been chopping sideways when you compare it to the S&P, even though there have been times earlier in the year. This is one of the real growth areas, and this really helps the market to go higher. And the fact that it's just kind of going sideways is a little bit of concern and showing that the big mega caps have been lagging lately. We would like to see this continue to go up and outperform if we're more positive on the S&P. If we see this ratio really breaking down, that will be a warning sign to us. Energy, which has kind of been all over the place. And this has been largely geopolitically driven, where it was spiking back up, coming down, now going back up, still in an uptrend right now. But when you compare it to the S&P, it is continuing to underperform. Financials doing really well. Had a good day. The big banks reported on Friday. There's going to be more bank earnings coming out, setting an all-time high here with this sector. And even though it's not really outperforming the S&P, it's holding up quite well. We've seen a recent golden cross with this ratio. Industrials also really driven by what is happening in the economy, looking pretty solid by themselves, and actually enough to generate a golden cross here. So showing a lot of improvement. This bodes well for the economy. Tech sector, not back to its all-time high yet, but still in an overall uptrend, and still in a downtrend, though, when you compare it to the S&P. To be more positive, to see the S&P really explode to the upside, we want to see this ratio do better than it has. since tech is such a huge part of the S&P 500. It's not falling apart, but it's not showing the strength that it was earlier on in the year. Staples, which are more defensive, think of toilet paper and toothpaste, pulling back recently to its 50-day moving average. And it's kind of interesting how this works. We just saw a recent golden cross with Staples to S&P. That's more negative. That means the market's getting more defensive. But ever since we saw that golden cross, you can see this ratio's been going back down. So it's kind of a contradiction right now. Real estate, which really liked that interest rates were going down lately, this has been pulling back to its 50-day moving average. But it's still kind of the same thing here. It had been going up and outperforming the S&P. Then we saw a golden cross. Now it's been pulling back and possibly bouncing off the 200-day moving average of this ratio. Utilities, which had been really strong lately, now have been pulling back a bit. And they were outperforming, but showing some weakness. But overall, they're still outperforming stocks right now, or the S&P 500. And then we look at an S&P to utilities ratio. Generally, when this is going up, that means it's more positive for the S&P because the S&P is outperforming utilities. Overall, this has been going down as utilities have been outperforming the S&P, even though we did bounce up with this ratio on Friday. Healthcare, another defensive area, came down below its 50-day moving average, now going back above the 50-day moving average, but still underperforming. It was showing a lot of improvement there for a while, but now that ratio is starting to come back down. Discretionary, the thing that makes life fun, still looking solid by itself, but underperforming when we compare it to the S&P. Semiconductors, a huge part of the tech sector, coming down, almost seeing a death cross here just within the sector itself, but we've been able to bounce up off of that at least so far. And then we look at a ratio between energy, which shows it's underperforming tech. And even though tech has been lagging, energy has been lagging even more. And growth areas versus bonds, more conservative areas, growth was really doing better, pulling back as we got concerned there. That was the big decline that we saw on August 5th. Since that time, we've been going up, and we haven't quite seen a death cross yet with this ratio. Then we look at the tech sector, compare it with the 10-year yield, showing how the tech sector is outperforming, and discretionary versus staples, where it's still showing that discretionary is in a downtrend compared to staples, but discretionary has been doing quite a bit better. It got hit hard on Friday because Tesla was down almost 9%. And then we look at the 10-year yield versus the tech sector, showing how the 10-year yield's underperforming tech. And here's another look at staples versus discretionary, showing how staples are in an uptrend compared to discretionary, but pulling back lately. Gold to the S&P just chopping around, but in an uptrend here as gold has been slightly outperforming stocks. And gold has been outperforming the dollar. That's when we see this ratio going up. But then gold was going sideways as the dollar was bouncing, and that was bringing this ratio down. But overall, gold continues to outperform the dollar. High leverage loans. I use this to measure what's going on with the economy. And this is coming off of setting an all-time high. So things are still looking good according to this ETF. The NYSE composite coming off of setting an all-time high. All stocks setting an all-time high. Emerging markets showing a lot of improvement, seeing some interest from folks here. And the Japanese Nikkei is a little bit above this previous high set back in 1989. They've been showing some improvement there with stocks in Japan. When we look at micro caps, we are in an uptrend. These are the smaller companies. And not really getting any insight here. We do the S&P, and then we look at the home builders ETF, and we look for divergences here. We saw one over the summer that really didn't mean anything. Right now, we're seeing that the correlation is pretty strong between the S&P 500 and the home builders ETF. Bitcoin is still in a downtrend and just kind of chopping around in the low to mid 60s. And China's been having a lot of trouble economically, and so there's a lot of stimulus and they're cutting rates. And so we're seeing a lot of money flowing into China now. That's really helped this oscillator, the KST, to really go up. And we're in an uptrend in emerging markets, but possibly rolling over. We're actually starting to turn down with this oscillator in Europe. Japan's starting to roll over, and we're seeing a little bit of weakness here in the S&P. So we want to watch this, but this is a long-term oscillator. And we look at InterMarket Analysis, which is the name of this video. And we go back to the beginning of the year, showing how gold is doing the best, followed by stocks, and then oil is in red. The dollar's in green, and bonds are still negative year to date. They had gone positive based on price. Now they've been showing some weakness lately. Then we look at some correlations. Stocks to the dollar, neutral right now. When we're in this blue area on the top to red area on the bottom, I treat that as neutral. We look at the correlation between S&P and oil, also neutral right now. S&P to the 10-year yield, showing that if interest rates are going up, generally the S&P is going up. They're having a slight tendency to go in the same direction, where you would think they would be going in opposite directions. So we might be seeing a little change of characteristic now with stocks to bonds and their relationship here. You can see how the S&P has been going up, and this dashed line is the 10-year yield. It's also been going back up. We look at the 10-year yield to tech, kind of seeing the same thing. Pretty strong correlated relationship where they're both going up at the same time. And then shorter term, the S&P 500, the 2-year yield, also a slight tendency to be going in the same direction. Then some long-term studies here. This is a monthly chart of the NYSE, just setting an all-time high above an advancing moving average, and the Copic curve, the momentum oscillator, is positive. So this broad market measure is looking quite good long-term. Here's the daily chart, and we're going up with the NYSE record high percent index. This is also going up. So on a daily basis and a monthly basis, we're looking positive, and even on our weekly charts, we're looking good too. Then we look at a monthly chart here, the S&P above an advancing moving average, and the PPO here rolling over a bit, but is still positive. And then we look at the S&P on top, and then a correlation between stocks and commodities, showing how stocks continue to outperform. And this is longer term. And we look at another S&P 500 to global index on a monthly basis, showing how U.S. stocks are outperforming, but we're still pretty much flat with the KST, another momentum oscillator. Then at the very end, I list all those things that are positive. And my definition of positive as it applies to this video is when the 50-day moving average is above the 200-day moving average. And we've got quite a long list. When you look at growth and value by themselves, they are positive. Copper is positive. The British pound, euro, they are in uptrends compared to the dollar. The Japanese yen is also in an uptrend compared to the dollar. Gold and silver are in uptrends. The big software companies, the mega caps, the FANG index, the low volatility ETF, when you look at it by itself, staples are in an uptrend. The Dow Jones Composite Average, all the bonds based on price and all the different indexes that we look at there, even though they've been pulling back lately, they're still in longer term uptrends. Tech and the semiconductors are in an uptrend. The high leverage loans, the Dow, the NYSE Composite and Wilshire, which are broad market measures, they're in uptrends. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps are in uptrends. All stocks, looking at US stocks as well as world stocks and emerging markets. And then we have kind of a short list of negative things right now. This is when the 50-day simple moving average is below the 200-day simple moving average. The CRB index, even though it was really up, it's still in a downtrend. The US dollar is still in a downtrend, even though it's been bouncing back up. ARK is still in a downtrend, and Bitcoin kind of bouncing up a little there, but also in a downtrend. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.